Hello everyone, and thank you for choosing this video to watch. This is going to teach you a lot if you're interested in finance and how debt can change your company's share price, or let's say the valuation, or the investors are going to like this about your company. So you're going to learn a lot. Just stay tuned till the end. So why is debt good? Apart from dealing payments, the basic macroeconomic aspect of it is simple. As more and more people spend because of debt, they are basically buying something they wouldn't have bought earlier, meaning they're spending more than they would have. So debt in essence is increasing spending. And why is that good? Because as more and more people spend, as more and more people take something and buy something, businesses grow. More consumer spending means more GDP growth. GDP is basically the sum total of all the consumer spending, or all the spending to be, straightforward in the economy. And GDP growth is associated with good economic growth. That is fine. Now, coming to a granular level, on a business level, why would you take debt if you were an executive in a business? Simply put, there is something called as cost of capital. Cost of capital is basically the expectation of investors. Now, when I learned this concept from my teacher, I was amazed. I was fortunate to have that kind of a teacher. Some of us already know this. Around 20 or 30% of you watching this video would already know about this, but need to refresh it. Remaining 70 to 80% would not be aware. So why is it good? Expectations of investors vary from the risk they take. Equity holders take more risk compared to debt holders. So, as an equity holder, my expectation from your business is going to be higher. Now, higher expectations, usually in finance, you'll find higher expectations would mean the business is riskier, because higher expectations come from the level of risk you take, as your risk is a bit higher on the higher end. So higher risk usually translates to higher cost of capital, and higher cost of capital basically means your company's valuation is going to come down. So how to reduce the cost of capital? Because everything else is going to be same. Your business is going to remain same. You're going to make the same level of sales. You're going to make the same level of revenues, and then pay the same costs. You're going to do all sort of activities, pay your employees. It's not going to change. So how does that help you with that? Simple logic is here. The total expectation of your investors, meaning not just the equity holders but also the debt holders in your business, have some expectations from you on the total basis. So usually how people value firms is this way. They take the overall value of the firm, or of the company, let's say, and deduct the debt from it to get the value of equity. So we also must understand that for that to happen, you must not have a very high amount of debt. Okay, but here is how debt improves or makes your share price grow, or you can make it grow using debt properly. As you have debt in your business, expectations are going to be lesser than equity holders, and combine the debt holders and the equity holders. When you put them together, you're going to see that the overall expectations are lesser compared to if you only had equity holders in your business. That translates to lesser cost of capital. Now, if that translates to lesser cost of capital, your valuation is going to slightly increase. But here is another good part. You're not only doing that, if you earn returns on investment that are higher than the cost of capital, you're going to generate wealth. And this is why is this a thumb rule? Basically, if I promised you, you give me $100 today, and I'm going to give you $12 tomorrow over that $100. So you're going to get 112. Okay, but I ended up giving you $15. Wouldn't you be happy? Wouldn't you be amazed? Wouldn't I be creating wealth for you? Wouldn't I be providing a lot of value? Yes. So if you at all exceed the expectation of investors from your business, you are going to create tremendous wealth for them and also attract more investors. So to keep that in mind, you have a constraint on the level you grow. That is going to be a business part. But if you can successfully keep the expectations on the lower end, you can easily make sure that you surpass them, or at least try to maintain them, so that your share price keeps growing. Why would that happen? If you exceed their expectations, they would know your business potential is more, and that's why they'll be willing to invest more in your business, simply put, right? So that is why, if your expectations from investors are reduced, meaning the cost of capital is reduced, and you still deliver the same amount of return on investment, the gap between the same widens, and as you deliver more and more, as the gap widens, the wealth creation for your investors is going to be amazing. And that is why debt is good for any listed company, or any company that is looking to get listed, or for anyone just in general looking to grow and understand about this concept. So thank you for watching, guys. Here is why TED can definitely improve your company's share price and position. And if you like this video and such kind of thoughts and thinking, leave me a like so that I know what to make. And next time we'll be talking about how to improve your negotiation skills.